Hi, my name is Clay Krebs. I'm a partner at Tonkon Torp LLP and a member of our Labor and Employment Practice Group. As our community prepares to reopen and get back to work, we want you to know we're here to help you. Our labor and employment attorneys are keeping up to date on the latest legal developments and are prepared to offer counsel, give advice, make online presentations, share written materials, or any other resources you and your business might need. Please don't hesitate to reach out to us. Click the link below to be connected to a Tonkon attorney. Take care and be safe.
First, I'm going to jump in and provide some background on the Paycheck Protection Program, more popularly known as the PPP, loan forgiveness requirements as included in the CARES Act. Drea will then take over to discuss the further guidance on loan forgiveness as provided by the PPP loan forgiveness application just published by the SBA this last Friday. We'll then have some time for Q&A following our remarks. So then first, some overview and context. The CARES Act containing the Paycheck Protection Program became law on March 27, 2020, and allocated $349 billion to the PPP, or approximately 15 times the total value of the SBA's primary lending program for small business, which is known as the 7A loan program, approved by the SBA in all of fiscal 2019. So the PPP is a giant extension of what the SBA typically does on an annual basis. The SBA published initial rules on April 2nd and began to accept and approve the first applications for PPP loans on Friday, April 3rd, 1 week after the passage of the CARES Act. The SBA then announced that the entire $349 billion initially allocated to the PPP had been committed on April 16th. So then in 2 weeks, almost 5,000 lenders wrote more than 1.6 million PPP loans as approved by the SBA, with an overall average loan size of approximately $206,000. In Oregon, there were 18,732 PPP loans approved in this round one, and the funding in Oregon totaled about $3.8 billion. So then on April 23rd, Congress allocated an additional $310 billion to the PPP in what is known as round two of the PPP funding, and lenders began accepting loan applications again on April 27th. As of May 16th, 2020, the date of the latest SBA updated report on the PPP, the SBA had approved an additional $195 billion in PPP funding to an additional 2.8 million borrowers in round two. In this round of funding, Oregon borrowers have received an additional 37,150 loans through May 16th, with total additional PPP funding of approximately $3 billion. There remains now more than $140 billion in PPP funds available for allocation in round two, with an overall average round two loan size to date of approximately $70,000. So then if you've considered but have not yet submitted a PPP loan application, it's still not too late. Contact your bank, compile your information, and submit your application as soon as possible if you'd like to take advantage of the loan forgiveness opportunity and other attractive terms of a PPP loan. Now I'm going to discuss PPP loan forgiveness program basics. Let's turn to the topic of the day: loan forgiveness requirements under the PPP. As a review for some, the PPP requires that loan proceeds be used only for payroll costs, mortgage interest, rent, utilities, and interest on pre-existing debt. It is important that a borrower clearly account for the use of PPP loan proceeds and be prepared to document their use in applying for loan forgiveness and in defending any review of the loan by the SBA following an application for loan forgiveness. More on the issues of preparing for forgiveness and potential loan audit in a minute. Up to 100% of the principal amount of a PPP loan may be forgiven. Loan forgiveness is available for the amount of the loan used for payroll costs, mortgage interest, rent obligations, and utility payments during the 8-week period beginning on the date of origination of the 7A loan. This is known as the covered period for purposes of the CARES Act loan forgiveness provisions. However, any amounts that are otherwise eligible for forgiveness will be reduced if, first, the borrower's average number of full-time equivalent employees, which we'll refer to as FTEs in this presentation, per month during the covered period has decreased compared to its average number of FTEs per month during a designated measurement period described in the Act. The loan forgiveness amount will also be reduced if the borrower cuts employee wages by more than 25%. As an exception to this exception, a reduction in the number of employees or the implementation of pay cuts will not impact the amount of loan forgiveness if the borrower restores the number of employees and or restores pay to prior levels by June 30th, 2020. So then, to obtain loan forgiveness, an applicant must submit a detailed application that includes documentation verifying the number of FTEs on payroll and pay rates for the covered period and any other applicable periods used in calculating the amount of loan forgiveness. The applicant must also submit payroll tax filings made with the IRS and applicable state authorities, and a number of other documents as detailed in the newly published loan forgiveness application. Drea will go over the detail of the application in her remarks to follow mine. For tax purposes, any loan amounts that are forgiven are excluded from the applicant's gross income for federal income tax purposes, and it's now been clarified are also not subject to Oregon's corporate activities tax. We'll move on now to PPP loan forgiveness and audit risk. Significantly, Congress enacted the PPP in response to the unprecedented economic disruption caused by COVID-19. The CARES Act specifically excludes the requirement that a PPP applicant not be able to obtain credit elsewhere from non-federal sources on reasonable terms and conditions, as would typically apply to an SBA 7A loan. As most of you are likely aware, the Act does require that applicants provide a good faith certification that the uncertainty of current economic conditions makes the PPP loan request necessary to support the ongoing operations of the applicant. The CARES Act, however, does not define necessity for purposes of the certification and does not describe the period of time during which support of the ongoing operations of the applicant is to be considered. Many commentators have suggested that any alleged failure of certification by an applicant should not give rise to legal liability because the standard established by the certification is unclear and, frankly, arguably unknowable. The SBA jumped into the breach on April 23rd in addressing this issue when, in its continually updated FAQ guidance, it advised that in making its good faith certification, a PPP applicant must take into account the applicant's current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. The SBA then advised that borrowers who repaid their PPP loan in full, first by May 7th, then extended to May 14th, and finally extended to this Monday, May 18th, would be deemed to have made the certification in good faith. Suffice to say that this updated guidance with respect to the content of the certification has been a primary focus of borrowers since its publication. I've spent many hours discussing its requirements with boards and senior managers of PPP borrowers in the past several weeks. The SBA was certainly able to get people's attention with this guidance following complaints about receipt of PPP loan funds by some large public and private equity-backed companies. The documented fact that a business was going to eliminate jobs or reduce salaries, but was able to avoid doing so because of receipt of a PPP loan seems to be among the best kind of evidence that the loan was necessary to support operations. It is at the core of what the PPP was intended to achieve. However, in trying to assess the applicable time frame of the certification, limiting the relevant period of support of ongoing operations to the 8-week period following funding of the loan, which again is the measuring period for loan forgiveness purposes, seems to be unreasonable. Businesses often project cash needs on a rolling near-term basis, built out to 6 to 12-month projections of revenues, expenses, and capital needs. The medium and longer-term economic impacts of COVID-19 over the next 3 to 12 months on a business remain unknown. Negative economic impacts may gradually occur in the second half of 2020 with unpredictable follow-on effects. The list of potential business issues is long. Business customers may no longer patronize business or go out of business themselves. Customers may delay payment or refuse payment. Supply chains may be disrupted. Employees may be reluctant or refuse to return to work. The financial system may face a liquidity crisis. The virus may reemerge and re-energize with the reduction of social distancing. The economy may need to be shut down again after current capital reserves and government funding have been used, and so on and so on. In the face of this ongoing uncertainty, the SBA finally published additional guidance with respect to the PPP loan certification requirement on May 13th. It may not be a coincidence that the SBA waited until the night before the published loan give-back deadline to make this announcement. The guidance states that all PPP borrowers who received a loan of less than $2 million will be deemed to have made the required certification in good faith. It further provides that the SBA's approach will allow it to conserve its limited resources to focus its review on larger loans where its compliance efforts may produce greater returns. Accordingly, it appears that PPP borrowers that received less than $2 million in funding are unlikely to be audited by the SBA. The SBA had previously announced that it would review all loans of $2 million or more. Significantly, it stated in its updated guidance that borrowers of $2 million or more who are found not to have made the certification in good faith will only need to repay the loan, and that the SBA will not refer the matter to other administrative agencies for enforcement action. In other words, the worst-case legal scenario for borrowers of $2 million or more who are found not to have adequate basis to provide the required certification. This is, of course, in the absence of actual fraud, which, if it is involved, will subject borrowers to criminal penalties and other things that are in the paper currently. Appears to be that these borrowers will need to promptly repay the loan funds. Regardless of the amount of a borrower's PPP loan, we believe that documenting decision-making and compiling information now with respect to the borrower's PPP loan may make loan forgiveness more likely and will help to prepare borrowers of $2 million or more for SBA audit. There's resources with regard to potential preparation for SBA audit available on the Tonkon website, and I refer that available information to you. As to one final but important point, the SBA stated in its interim guidance on loan certification that it would review all loans in excess of $2 million following submission of the borrower's loan forgiveness application. Keep in mind that a borrower is not required to submit a loan forgiveness application. If, after June 30, a borrower determines that its business and the economy is better than it projected, and it is uncomfortable requesting forgiveness of its loan, it can determine at that time to repay the loan with little risk of sanction by the SBA. The primary potential business risk in participating in the PPP for the great majority of businesses then is reputational, not audit or criminal. This last point is important, I think, for many businesses because waiting to make a determination about forgiveness until after June 30 provides an additional 60-some days of visibility about a business's actual situation and allows for a more informed decision at that time about the desirability of applying for loan forgiveness. And with that said, and on the assumption that most borrowers remain very interested in the possibility of loan forgiveness and in the detail of the newly published loan forgiveness application, I'll wrap up and pass it over to you, Drea.
Thanks, Jeff. And thanks everyone for being with us this afternoon before this long holiday weekend, as unusual as it may be. So I'm going to talk a little bit about the specific additional guidance that we received in the PPP loan forgiveness application last Friday night. But before I jump into the details, I want to say just a few words about the application itself. Many of you out there may have already seen the application. It is posted on the SBA's website. It's 11 pages long. It's 11 dense pages, but I do recommend that folks go ahead and pull the application and take a look at it, give it a read. It will start to give you an idea of what we're going to be looking at to actually fill this out to submit for forgiveness. And the SBA at this point is anticipating that the application is going to take about 3 hours to fill out. I think at this point, based on a detailed read, it looks like there's still some information in the application that we still don't have the required guidance to be able to actually fill out, but hopefully we will have all that information within the next couple of weeks, so folks are in a position to do that. And the other thing you will notice when you take a look at this application, it is made up of the application itself, and then it also has a Schedule A and a worksheet to Schedule A, and those are included for purposes of doing the calculations that you're going to need to do in order to see whether you need to reduce your loan forgiveness or whether you are going to be eligible for one of the safe harbors from the reduction in loan forgiveness. So that there's some really important information there, and I would encourage you to take a look at it. But with that, I'm going to go ahead and jump into a few of the details. So the first set of changes that I want to highlight deals with payroll costs. And there is some guidance here that I think will be beneficial to borrowers who are struggling to maximize their forgiveness. I think one of the things we've seen is that folks took out a loan, but then once we started to dig into it, to the way that the statute worked and the way that the initial guidance worked, it looks like it's actually going to be kind of difficult to figure out a way to spend all the proceeds in a way that makes sure that they're all actually forgiven. And there is some flexibility here in the application that I think is going to help. First, the application allows borrowers to elect to use an alternative payroll covered period. And these borrowers who elect to do this can elect to calculate their payroll costs for purposes of forgiveness using the 8-week period that begins on the first day of the first pay period following disbursement. For those who have already sort of memorized what all the rules are and what they were prior to this release, you will know that what we thought initially and what we were told initially is that all expenses, in order to be forgiven, needed to be used within the 8-week period following disbursement of the loan, meaning the day that you actually received your funds. And this was difficult for folks because it didn't necessarily align with their payroll. And as Jeff mentioned, you are required to use 75% of your proceeds on payroll. So allowing borrowers to elect to use this alternative payroll covered period for payroll costs only, and that is an important distinction, will help folks be able to fit more of those payroll costs within the forgivable period. So the next point that I want to highlight deals with a long-standing debate that we've been having over whether payroll costs actually need to be both incurred and paid within the covered period, or now the alternative payroll covered period, which is something that we will be dealing with going forward, or whether expenses and payroll costs in this case just needed to be incurred or paid within the covered period. The application clarifies that the operative word here is or. So specific to payroll costs, what that means is that any costs that were incurred for payroll but not paid during the borrower's last pay period of the covered period will be forgivable if they're paid on or before the next payroll date. So that's going to be pretty significant for, I mean, in a way it deals with the same problem as the alternative payroll covered period, but it does allow borrowers to pay payroll during the covered period and have that amount forgiven, and also to be able to pay payroll that was incurred during the covered period, even if the payment of that payroll is actually a week or several days following the end of the covered period, to have that amount forgiven and included in your covered costs for forgiveness purposes. So I think that that's going to be significant for folks. And the last point that I want to make related to payroll costs has to do with owner compensation. The application confirms what we already knew based on some prior guidance, but it's helpful to have it laid out in this way. It confirms that owner compensation is eligible for forgiveness, and it is included as a payroll cost. And what that means is that owner compensation counts towards the 75% of your loan that needs to be used for payroll costs. And you know, this is gonna be significant for some folks, especially for people who potentially did not actually include owner compensation in their initial calculations of their loan amount, but then they're concerned about whether they were actually going to be able to use all of their expenses towards payroll costs. If you include owner compensation in that number, you should be able to increase the amount that you're actually spending on payroll costs. But there is a limitation here. Owner compensation is going to be capped at the lesser of 2019 owner compensation, or $100,000 on an annualized basis. And what that means for the covered period, or the alternative covered period if you elect to use that, is that owner compensation would either be 8 weeks, the max of 8 weeks of your 2019 compensation, or it would come out to, the annualized $100,000 would come out to $15,384 for the 8-week period, but it needs to be the lesser of those two numbers. So the significant takeaway here is owner compensation is includable, but it's going to be limited based on 2019 compensation up to the very max of $15,385 for forgiveness. All right, so moving on to non-payroll costs. So as a reminder, I think everyone has heard many times by now that you need, for maximum forgiveness, you need to use at least 75% of your loan on payroll costs. And so that means that non-payroll costs can only make up 25% of what you spend your loan proceeds on in order to be eligible for forgiveness. And also, I just want to point out here that even though there is an alternative payroll covered period for purposes of payroll costs, for purposes of non-payroll costs, borrowers still need to look to the original covered period. So the relevant period is still going to be the 8-week period that follows the disbursement of your loan. So that can make things a little bit confusing for calculating. I think we can get through it, but it is what it is. So similar to the new paid or incurred rule for payroll costs, under this application, non-payroll costs, and this includes mortgage interest, rent obligations, and utilities, they can be included for forgiveness if they are either paid during the 8-week covered period or if they are incurred during the 8-week covered period and paid on the next regular billing date. So same concept as with payroll costs. It gives you a little bit more flexibility to include costs that are either paid or incurred during the covered period. The application also gives us just a little bit more information on what is actually included in the non-payroll cost number, and these will also be helpful for borrowers. Rent is clarified to include personal as well as real property. So that means that equipment rentals can be included. Initially, we thought that only it was your rent for your real property, only your rent on your building, that could be included, but the application clarifies that personal property is also included. So that should be helpful. And in addition, the application also clarifies that utilities also include distribution of electricity, gas, water, transportation, telephone, and internet access. So there's a little bit of new information there. I think we've gotten a lot of questions about things like whether your internet should qualify as a utility. I think certainly most of us use it as a utility these days. And additionally, I've had some questions about whether cell phones or cell phone service would be included as a utility. We do think that cell phone service will be included. Costs for cell phones themselves, however, I think probably would not be included as a utility. So something to keep in mind there. And yeah, so that's what we know about non-payroll costs for the moment. The last category of updates that I'm going to discuss relates to forgiveness reductions. The application contains detailed schedules, as I mentioned, and it also contains calculations that are specific to forgiveness reductions. This is definitely the most complicated part of the application. And I think as you work through it, you're gonna realize that you probably will need to do it a couple of times to feel comfortable with it. I'm not going to go through all of those specific details here because I don't want to bore everyone to death. And I think that that would be, it's pretty fact specific for most people. But I think you're definitely going to want to take a look at that, and your CPA or your other advisors can definitely help you kind of work through some of those things. But I do want to highlight some useful points. As Jeff mentioned earlier, your forgiveness is reduced if the number of full-time equivalent employees is lower during a specific pre-pandemic period compared to your covered period or your alternative loan or alternative payroll covered period if you elect to use that. So one of the specific bits of information that we didn't have until the application was released was how the SBA was going to define an FTE. Under the application, an FTE is an employee that works a 40-hour work week. And this is a little bit different than what we expected. We anticipated that based on other so the Affordable Care Act defines an FTE as the 30-hour work week, and we thought that something similar would be used here. But the SBA has specified that a 40-hour work week is what they want to use. And so borrowers are supposed to calculate your FTEs by entering the average number of hours paid per week per employee. Then you divide by 40 and you round to the nearest tenth. That's the first way that you can figure out each employee's FTE number. Alternatively, you can use a simplified method that counts employees that work 40 hours as 1.0, and no employee can count for more than 1.0 than one full-time employee. So if you have folks working 50 hours, they do not count as more than one full-time employee. Under the simplified method, a 40-hour employee counts as one, and any employee that works less than 40 hours counts as 0.5. So regardless of which method you choose, and I expect that folks will probably do it both ways and see if it makes a difference for them if they use one over the other, but whichever alternative you choose, once you've calculated the FTEs per employee, you add those numbers all together, and that is the basis of your FTE calculation. So if your FTEs, based on the result of that calculation, during the covered period are lower than during the comparable pre-pandemic period, then your forgiveness is going to be reduced based on, again, the calculations that are included. Another piece of information that we learned is that the reduction, there's also a reduction in your forgiveness if you reduce employee salaries by more than 25% during the covered period as compared to the most recent full fiscal quarter. In the application, we learned that this reduction needs to be calculated on an employee by employee basis rather than in the aggregate. So you would figure out whether a specific employee has had their salary reduced below 75% of what they earned in the first full quarter of the year, and anything above a 25% reduction will reduce the amount of a borrower's forgiveness. One more piece of information on that, the SBA specified that the applicable period, look back comparison period for purposes of salaries is January 1, 2020 through March 31st of 2020. So all borrowers will use the same period for that. The last little piece of information I want to add relates to the safe harbors from reductions to your forgiveness amount. So there are safe harbors that basically the SBA has said, okay, if you reduced your full-time employee count during the pandemic, or you reduced salaries during the pandemic, but you get salaries or your FTE numbers back up by June 30th, we are not going to penalize you for that. This is a very tricky and specific part of the rules. So I'm not going to go into exactly how all that works here, but we did get some useful additional information that for folks who have had some difficulty hiring folks back to come back to work, there are a couple of exceptions where you won't have to count an employee against your FTE number for purposes of figuring out whether you are eligible for this safe harbor. And those are, if you offer to have employees come back and you make a good faith written offer of employment and the employee declines for whatever reason, that will not count against you for purposes of forgiveness reduction. In addition, something new that actually came in the application, so you won't have to count employees who are fired for cause, or if they voluntarily resign, or voluntarily request and receive a reduction in hours. None of that will count against you for purposes of your forgiveness calculation. So with that, I'm going to take a quick step back. I've thrown a lot of really technical information at you about some of the new information that we learned from the application. If you have further questions, we will try to answer some questions here, but I know that folks are going to have a lot of probably very specific questions. And, you know, I would encourage you to reach out to us or reach out to your CPAs. And there are lots of folks who are really paying attention to all this and can kind of give you a little bit of guidance on your specific situation. So with that, I just want to talk a little bit, very briefly, about how I think about the key takeaways for purposes of where we are now. In the last webinar that we did, I talked a little bit about some practical advice for folks as they go through this process. And my practical advice hasn't changed. I think we are in the middle of this process and there will be more changes. I read yesterday that the Senate is talking about expanding the time period for use of funds up to 16 weeks. And I know the House wants to extend it up to 24. So I think that there are going to be further changes and folks are going to need to continue to pay attention. So I just want to reiterate the things that I said on our last webinar and remind people that there are a couple of ways to think about this. So first, have a PPP point person. This is probably the person in your organization who is attending this call. And they're just going to need to stay in touch with your CPA, with your attorney, with your lender, to figure out where things stand and to figure out the best way forward for you. Also, you know, time continues to be of the essence at this point. I think many of our borrowers are partway through their forgiveness or through their covered period. So we want to make sure that get everything done in a timely manner. Documentation is key. If you take a look at this application, it will give you a list of the specific documents that the SBA is going to be looking for. And it's a great idea to go ahead and start keeping track of those documents. And lastly, stay in the loop with your lender. Your lender is going to be there. They're going to be the ones, especially if your loan is under $2 million, your lender is going to be key in your determination forgiveness. And they may have different ways of addressing how the forgiveness process works. So just want to encourage people to keep a good line of communication with their lenders. And with that, I will turn it back to Jeff to give a few final thoughts before we take questions.
Yeah, thanks, Drea. Well, I just like to make a few comments following on from your remarks. First, and this may be the least helpful thing that I say, but this is ridiculously complex. Reading through the loan forgiveness application and the math involved in looking at compensation reduction as it factors into reduction of loan forgiveness gives a really good sense of a program that's got a super high technical level of detail that just kind of keeps going. One thing I would say, following on from the documentation advice that you gave, I mean, keep in mind, as I mentioned a little while ago, that this program was put into place, adopted, applications were taken in a week. And it was a crisis. It was in the midst of shutdown orders, and it was in the midst of profound uncertainty across our business clients as to what was going to come next. That uncertainty continues, but one of the things that I think is very important as we take a step back, as we sit here, many folks with loan proceeds in hand thinking about forgiveness, is that it's very important to document now the decision that was made to take a PPP loan, right? I mean, for a lot of businesses, that was a decision made quickly over a weekend, over a few days. And it may not have involved the same business process that would typically go into making a board decision. But it's important to go back to the extent possible, document now what was the basis for the decision so that you have that in a record for purposes, one, of making a case to the SBA should they make it an issue, but also to make clear for the business messaging, business documentation generally, that this was a substantive basis of the decision that we made. Second, to Drea's point, I mean, one of the things that's hard about the PPP is that the rules keep changing. Literally on a daily, weekly basis. It's a source of great frustration. The SBA publishes FAQs that circle back on themselves. Some of them, frankly, look to change the law more than they look to interpret the law. Congress is quite interested in what's happened in the SBA. To Drea's point, a number of the points that we made in this presentation may change. The 75-25 split, I think, is on the table as a potential item of change. The 8-week pay period is on the table as an item of potential change. I mean, the fact is that the PPP does not work well for a broad cross-section of businesses as currently implemented. For example, bars, restaurants, other businesses. It's hard to spend money on payroll when the government's told you can't operate. And that's a basic reality that Congress is attempting to address. I provided context ahead of the great detail that Drea provided on the loan forgiveness application. Keeping in mind, the SBA has written over 4 million loans totaling over $500 billion to deserving borrowers, large and small, without financial underwriting and subject to a general and undefined borrower certification based on the fact that at the time the PPP was enacted, the government had shut down the economy for health reasons in an unprecedented fashion, creating primary economic uncertainty for a huge cross-section of American businesses. And what I would say from my experience in the last several weeks, I have very regularly been having conversations with businesses that it's quite important to keep in mind the requirements of PPP loan forgiveness, but in that process, it's very important not to get lost or moved away from making business decisions that are in the best interest of the business. And all of this detail requirement can have a tendency to move people to worry, second guess, when in fact they're dealing with questions that are subject to the business judgment rule, that are subject to good corporate decision making, unknowable ultimately in some ways with regard to the PPP, but within this reasonable range of gray, and that the default needs to be, yes, we've taken the PPP into account, we're conscious of the guidance that's available, and we need to continue to make the best decisions we can for the business on a more holistic basis. And so with that, I'll wrap up on takeaways. And Drea, do you want to move on to taking a look at Q&A?
Yeah, absolutely. So we have a pretty good number of questions in the queue, and we are going to try to tick through some of these, especially to the extent that they may be applicable to the group as a whole. So let's see here. I have a question coming through on transportation costs, and what is included in transportation costs for purposes of the utilities definition. And unfortunately, this is one of those questions that we don't know very much about. At this point, we think that gas will likely be included in transportation costs for business purposes, but we don't have a lot more information on that at this point. And so we are hopeful that the actual guidance that when the SBA comes out with final or interim final rules on forgiveness, that we'll get a little bit more information on some of those things. But for the moment, that is all we have. And just related to that, I see another question about whether website hosting can be considered a utility. And at this point, I think based on the information that we have, the internet access for internet service would be included as a utility. And absent any further guidance, I would not include website hosting as a utility, as a covered expense. Jeff, there's a question here. Do you have any thoughts on how to best record forgiveness of the loan on a company's financial statements?
I think that's a good question for your CPA, but it would need to be an offsetting asset on the balance sheet for expenses incurred. And I frankly haven't seen how that's been noted yet. How the CPA firms will prefer to describe that. I see a question here. If my loan was less than $2 million, do we still need to fill out the forgiveness application? The answer to that is yes. You do need to fill out the application in order to obtain forgiveness, but you'll be in the fortunate circumstance of being in the class of businesses that are quite unlikely to be subject to review of that forgiveness application by the SBA.
I have a question here about, can I use back pay incurred for previously laid off employees as part of my 75%? So this is a question that I have encountered a couple of times, and I think at what we know is that if you're paying for a previous period and you're not paying it in a regularly scheduled payroll, you are likely not going to be able to include any kind of back pay for previously laid off employees for your 75%. The limited additional guidance that we received in the application seems to clearly apply to a regularly scheduled payroll that happens to be paid after the beginning of your covered period, but it doesn't, and it relates to work that was done prior to the commencement of the covered period in the ordinary course. So unless we get alternative guidance on that, I think the answer to that is no. Generally, you can't use it for back pay for employees that have otherwise been laid off.
Yeah, I think there's similar questions, Drea, about retirement fund contributions, bonus payments, and there's certainly a gray area there. I think that to the extent that payments have been made during the period in the ordinary course, and historically, I think there's a case to be made that they can be counted for purposes of legitimate business expenses. And, I would expect that these and similar issues will be addressed in the long-awaited SBA guidance on loan forgiveness that is several weeks late now. But the list of very, very detailed questions about similar issues is very long.
Yeah, I think, that's a great point, Jeff. I've heard quite a few questions about, so let's say that, you're having trouble using all of your funds, and I've heard folks want to think about whether they can pay a bonus to employees or whether they can actually increase the amount that they're paying to employees during the covered period. And I think what we know right now is that there is no prohibition on doing that. I think you want to have a legitimate business purpose for the decisions that you're making. And so, if it makes sense to pay hazard pay or some kind of a bonus to folks who are carrying a heavier weight during this period of time, that makes a lot of sense. But I think there is some good sense business judgment here, where you just need to make sure that you're making decisions that are defensible for the purposes of your business.
A good question for you here, Drea. Does the forgiveness application give us calculations to determine how much of my loan will not be forgiven?
The calculation the application gives you specific calculations that will give you an idea of how much of your loan will, and as a result, won't be forgiven. The difficulty in answering this question is that unfortunately, because there are some of the components of what will go into the numbers that you're actually putting into the calculations are still unclear. For example, what specifically applies or qualifies as a utility. Because some of those questions are still out there, it becomes a little bit difficult to get to a sure answer on that, but there are calculations in the application to give you an idea of how much will and will not be forgiven.
Yeah, I notice, Drea, that quite a number of the questions in the queue address specific employee employment issues, and I guess I would refer participants to the labor and employment webinars and materials that are available on the Tonkon website addressing a number of these specific labor and employment issues as related to COVID. Maybe we'll try just one or two more here before we wrap up at the top of the hour. Have a question here: are S corps treated differently for PPP loan forgiveness purposes? I think the short answer to that is no, not in material ways. Drea addressed earlier owner compensation inclusion, and that could have been an issue with some owners of S corps, but in general, it's the same process for S corps.
And just maybe to answer the one last question here, regarding employees, I see some questions about, what happens if you don't have funds to retain employees through June 30th, which is the specific date for purposes of the safe harbor. And the answer to that is you first need to figure out whether you need to satisfy the safe harbor. If your employee count during your covered period is already the same as your pre-pandemic period, then you don't need to worry about qualifying for the safe harbor and making sure that you rehire by the 30th. But with that said, if you do need to make use of the safe harbor, then it is going to be key that you actually have your FTE numbers and your salaries back up on June 30th without regard to whether you've actually run out of your funds. So, there are a lot of different factual permutations there. But it really depends on whether you need to make use of that safe harbor or not to determine whether that June 30th date actually has relevance for you. So with that,
Drea,
oh, go ahead, Jeff.
I was just going to say that I think it looks like it's about time to wrap up. I want to refer the group to the COVID resources page on our website. There's lots of good information available there, the L&E background information, but in many other areas, corporate, tax, and others. I think a wealth of resources. I would say a couple of particular resources for most all PPP borrowers. There is a preparation for audit and or application for loan forgiveness sort of checklist issues list that I think is worth taking a look at and thinking about the issues identified there in preparation for a forgiveness application or for larger borrowers, a potential audit, and also for larger borrowers, not published yet, but coming, is an overview of the economic uncertainty, Oregon and Washington, addressing governor's order shutdowns and other economic impacts in this region, that I think is and will be a useful background document for companies as they look to document the economic uncertainty to which they were subject in making a PPP loan request. And with that, Drea, thank you for joining me, and thanks everyone for being here, and we look forward to next time.